Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. From State Bank of India to Bank of Baroda, banks are rushing to woo depositors with attractive rates. And these deposit rates may soar further as most economists believe that the repo rate will rise to 5.75 to 6% by the end of this calendar year. So, what is in the store for investors? Let's find out.
SBI, Bank of Baroda, Canara Bank, ICICI, HDFC, Axis Bank and several other lenders have hiked their deposit rates to attract funds. It comes at a time when growth in bank loans has surpassed deposits. SBI has launched a 75-day Utsav deposit scheme, which is offering 6.10% for fixed deposits. Senior citizens will get an additional 0.50%. The offer is available till 30th of October. Bank of Baroda has announced its Baroda Tiranga deposit scheme. Under it, deposits are available in two buckets. One offers 5.75% per annum for 444 days and another offers 6% for 555 days. The scheme is available till the 31st of December. It is for retail deposits below 2 crore rupees. Senior citizens will get an additional 0.5%. Non-callable deposits will get an additional 0.15%. Canara Bank has also launched a 666-day deposit scheme offering 6%. After the Reserve Bank of India's move to hike the repo rate by 50 basis points on the 5th of August, a number of lenders have raised fixed deposit rates in various majorities. Experts had said that while FD rates had risen, the pace had been slow. Overall, the transmission of repo rate increase to FDs has been much slower than the transmission to lending rates. So, given the situation, will the rate increases be enough to benefit investors with FDs? Also, will the higher FD rates lure away equity market investors?
So a couple of points here. First is that fixed deposits always struggle to beat inflation, and that's something we have seen across the board, right? So rates are rising, but rates are rising because interest rates are also rising, right? So inflation is also rising. So that's not uncommon. It keeps happening all the time. So if you are betting on FD increase in FD rates to beat inflation, you are banking on a lot of luck, which may not come your way, right? So I think for that, again, it's a different topic, but I think you might need to look at some of the growth assets in your portfolio. Now, for somebody who has to make a choice between a bank FD and let's say a riskier product, let's say stocks or equity markets, like equity mutual funds, I think a lot would depend on their outlook and of course their recent experience. So I don't think FD rates are that attractive at this point in time where people will start moving out of their stock market investments. FD rates are between 5.5 to 6.57%. These are not very, very, very lucrative, right? So unless somebody has had a bad experience in the markets and they want to move out of the equity markets in general, or unless somebody feels that equity markets are stretched at this point in time and let me save some money, I don't think people will suddenly start taking out money from equity markets simply because FD interest rates have gone up by, say, 0.51%.
The 3 consecutive rate hikes mean further momentum for rising fixed deposit interest rates. Clearly, the era of extremely low FD rates is over. Still, avoid excessive reliance on FDs. When one accounts for both inflation and tax, returns from bank FDs are negative. However, you can opt for FDs for short-term capital protection, for example, for parking emergency funds. The benchmark repo rate now stands at 5.4%. Cumulatively, the central bank has hiked the repo rate by 140 bps in this cycle. Going ahead, most economists expect it to rise to 5.75 to 6% by the end of this calendar year. So, how should fixed deposit investors calibrate their strategies? If you are starting with FDs now, you should opt for shorter tenures. Why? So that you can roll them over into higher rate deposits when the former mature. According to experts, you should also avoid the auto renewal facility. That will allow you to renew your FDs at the best rates after taking into consideration your investment horizon and the highest available slab rate. Experts also say that you should create a ladder of maturities. Basically, invest in FDs maturing at different times. Doing so will minimize the risk of reinvestment. Also, a laddering strategy will ensure cash flows at regular intervals.
The second point is if your premise is that the interest rates are going to go up. Now that's the premise. We don't know if that will happen or how that will happen, what will be the pace of all this, what will be the trajectory. But if as investors you feel that interest rates are going to go up, I think then you must open shorter term duration FDs, right? So let's say instead of opening 5-year FD, you might want to open just 1-year FD, right? So look at the maturity points and the interest rates on the FD rates that the banks are offering you for those maturity points. It's possible for 6-month FD you are getting 4.5%. For 1-year FD you are getting 5.5%. For 2-year FD you are getting again 5.75%, right? Now the difference between 6-month and 1-year FD is about 100 basis points. Between 1-year and 2-year is 0.25 percent. Now, in that case, if the premise is that rates are going to go up, you can look at shorter duration FDs instead of longer duration FDs.
Remember, guessing the best time to opt for long-term FDs is a risky proposition. You might think that interest rates have peaked, but they could increase further.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Pandemic and subsequent supply chain disruption has not just pushed inflation, it also led to shortage of semiconductor chips. Mercedes CEO Ola Källenius recently said that the shortage of these chips will last throughout this year and into 2023. And now the face-off between China and Taiwan is threatening to make the matter worse. Our next report tells why.
Speaking at the Mahindra & Mahindra's annual general meeting recently, its chairman Anand Mahindra said one of the key reasons for the long waiting period for delivery of vehicles is the supply chain disruption. In his words, the availability of semiconductors had slowed down to a trickle. Caused by pandemic supply chain disruption, combined with stronger than expected demand recovery, the global chip shortage over the past 2 years is refusing to go away. India's biggest car maker Maruti Suzuki said it could not produce 51,000 units in the April to June quarter because of this. And according to the second largest car maker Hyundai India, which expects the semiconductor situation to improve only next year, the demand is outstripping the supply. In the April to June quarter, the domestic passenger vehicle sales stood at 9.1 lakh units, a 41% growth compared to 6.46 lakh units last year. PV sales are on track to touch a new record this fiscal, beating their FY19 peak. But the geopolitical fallout of a top US official's visit to Chinese claimed Taiwan earlier this month is threatening to prolong the chip shortage. US House Speaker and longtime China critic Nancy Pelosi's visit was the highest level US visit to the self-governing island democracy in 25 years. Her one-day trip worsened the tensions between China and Taiwan. An outraged China reacted by launching its biggest ever military drills in the seas around Taiwan, which is home to the world's biggest contract manufacturer of semiconductors, TSMC, and its peer, UMC. They are major suppliers to global tech giants, auto companies, and producers of consumer electronics. TSMC alone makes 80% of microcontrollers used in cars. China's military exercises, which include firing live missiles and deploying fighter jets, bombers, and warships around Taiwan, disrupted key trading routes for cargo and commodities sailing around the world. For the first time, the Chinese army practiced operations aiming at a blockade of the island. China suspended exports of natural sand to Taiwan and halted imports of fruit and fish products from the island. Quartz sand, a type of natural sand, is an important raw material for chip manufacturing. On August 10th, China's military said exercises held around Taiwan in response to Pelosi's visit had concluded while pledging to continue regular patrols near the island.
Start of this current calendar year, say early January, February, we started seeing some kind of ease out, particularly with respect to the chips. Yes, as we speak, these are set of new challenges which have been built up. It's largely, the kind of intimidation or the power which one country would like to exercise on the other. And it puts a larger amount of threat on the semiconductor manufacturing industry. There are going to be multiple effects with respect to the supply chain ease of the semiconductors in the short to mid-term. When I say short to mid-term, our internal assessment says that it will take 2 to 3 quarters minimum for the things to get eased out. Does it mean that in India, when it comes to automotive as a sector, we'll keep on struggling? My answer would be yes. With the upcoming festive season coming up, a lot of these car makers or the OEMs would be kind of putting a lot of pressure on the dealers to stack the inventory. So the backlog which we are seeing will get refilled in the subsequent months. That's what our assessment says. So that the people who had done their bookings earlier or the demand which will come up during the festive season is to a larger extent will get met out. The backlog will continue to go up over the next 2-3 quarters. Production capacity may not be optimally utilized.
The Indian Cellular and Electronics Association estimates that foundries in Taiwan account for more than 75% of the chips that mobile devices made in India need. The number is slightly lower at 60% if one considers all chips, those of consumer electronics, PCs, laptops, automobiles, etc. With the festive season coming up, how are India's smartphone manufacturers placed amid the latest geopolitical tensions?
Taiwan is obviously very important for the world and even for India, even for China. China obviously knows that when they are trying to put the blockades, that their imports for these things will be hurt there. So I think they are aware of the fact. Quartz is a very important thing. This can actually hinder some of the supplies and actually reduce some of the supplies. It's going to be problematic if this goes on, if there's no solution for the next 3-4 weeks. Supply situation has been becoming quite okay in the past 2-3 quarters, to the extent that right now the ceiling is being put by the demand contraction, not by the supply, which was unlike for the past 2 years. To that extent, most of the brands are okay with supply of chipsets or the component leading up to the festival season. And you have to remember that almost 2/3 of the India smartphone market is still with the Chinese. They'll also lobby that we can't do that. It's a loss of revenue from an important market like India as well. Will this be price increase? Absolutely, it can be there because of the input cost increase, the assembly cost increase in India. So logistics has gone, fuel has gone up. So price increase has been happening. We are at the highest ASP ever. It's a catch-22 for the brands. They were expecting actually to clear off a lot of inventory which is lying in for some of the models. They were expecting that a lot of affordability schemes will come in.
For the smartphone industry, a slowdown in demand is the bigger challenge. India's smartphone shipments fell 1% in the first half of 2022. World chip sales growth has also been declining for 6 straight months. Semiconductor sales rose 13.3% in June, down from 18% in May, according to the World Semiconductor Industry Association. A chip shortage will, however, hobble the automotive industry for a few more quarters. Having said that, experts believe a blockade on Taiwan's exports or widening of sanctions to cover semiconductors is unlikely, as it is also not in the interest of China, given its heavy reliance on Taiwan for advanced chips.
हाल?
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Xiao Haishan, the chief of China's top chip maker SMIC, last week said that rising geopolitical tension and high inflation are adding to industry panic. In India too, the central bank is on a firefighting mode. It has been raising key rates to bring down inflation, which in turn is making banks jack up their deposit rates to fund loan demand. Will these rate hikes lure equity investors to safer bank assets? We find out in our next report.
As credit growth picks up at a faster pace than deposits, several national banks are resorting to raising deposit rates to meet loan demand. As of July 29, aggregate growth in bank deposits was only 9.1% on a yearly basis versus 14.5% 1 year ago, as per RBI's latest data. Against this backdrop, the country's largest lender, SBI, recently launched a special 75-day deposit scheme offering 6.1% annual returns on fixed deposits with a tenor of 1,000 days. Bank of Baroda and Canara Bank have also unveiled similar schemes. The rising rates on safer assets, such as fixed deposits, are, however, not enough for equity investors to park or diverge their funds, according to experts. G. Chokalingam, founder and chief investment officer at Economics Research, believes a majority of investors will not shift significantly towards fixed income instruments just because interest rates are 50 basis points or even 200 basis points higher. Historically, equity market investors have seen strong double-digit interest rates offered by banks, still allocated to equities. They now expect a minimum of 15% annualized returns, if not multi-baggers, within a year, he says. Over the past few years, market returns have been much higher than that of bank deposits. Incidentally, between 2019 and 2021, the Sensex and Nifty indices have returned between 14 and 22% each year, while a one-year FD in a nationalized bank like SBI has moved from 4.9% in 2019 to 5.3% in 2021. At the rates being offered by banks, the overall return on investments is still negative if one considers the post-tax return, analysts said.
Even if you go to 8% interest rates, if you take into consideration and tax, you are still not making anything. So, I mean, people will, some of the, I mean, I'm not against FD, even I have FD, to be very honest with you, personally speaking. Okay. So, as a principle of investment into, any kind of an asset class, it is always better to diversify. But don't put large part of your investable, capital into bank FD. Even if you take 10% return from where we are today, you are staring at 65,000 plus. You may get it more. I'm talking about the lower side. So, I mean, you are better off here. I mean, only thing is, don't buy any nonsensical stock and expect to make return. Buy quality, don't buy quantity.
Narendra Solanki of Anand Rathi also has a similar opinion. Market valuation, he said, has become reasonable for investors to get in.
Don't think there will be any immediate large shift from asset classes like equities into FDs, as equities provide greater alpha over FD rates in medium to long term, and with recent fall, the valuations have also become reasonable in some pockets. At most, there could be some shift from short-term based instruments or liquid-based fund into FDs.
On Thursday, the markets will react to the minutes of the US Federal Reserve's July meeting. Back home, stock-specific action will continue.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
From the markets, let us turn our focus to a bill through which the government wanted to usher in what is called much needed reforms in the power distribution sector. But the Electricity Amendment Bill 2022 met with stiff resistance. Watch our next segment to know both sides of the debate. Within hours of tabling it in the Lok Sabha on 8th of August, the Central sent the Electricity Amendment Bill 2022 to a Parliamentary Standing Committee for wider consultation with stakeholders. The bill met with stiff opposition inside and outside the Parliament. So, what the government wanted to do through these amendments? Through the changes in the law, the government wanted to introduce the concept of open access, which will allow consumers to choose their electricity provider regardless of who controls the physical infrastructure in their locality or state. This would be similar to the way in which we select our mobile and internet service providers. How will it do that? The bill will allow multiple distribution licenses to function in an area. Having been cleared by the Union Cabinet, the bill proposes to amend sections 42 and 14 of the Electricity Act. Thus, it will enable competition in retail power distribution. The proposed amendment will allow the use of distribution networks by all licenses under provisions of non-discriminatory open access. The freedom to choose will be provided through multiple distribution licenses on the same network. According to Business Standard opinion, successive governments since 2003 have sought to introduce this principle into India, but each time poor drafting and strong opposition prevented its application. The paper has argued that consumer rights must be respected through a principle like open access and that its application is overdue. However, consumer choice will mean that poorly performing state electricity utilities could end up being shunned in favor of their better performing counterparts. The bill will also allow graded revision in tariff over a year. It also says that an appropriate commission will fix the maximum ceiling and minimum tariff. Another amendment proposes to strengthen the regulators and the functions carried out by them. However, the centre has dropped the proposal of privatizing state-owned power distribution companies. But why are opposition parties and farmer unions against it? The opposition is alleging that the amendments will effectively curb the right of state governments to regulate tariff and distribution and are against India's federal structure. They also allege that these amendments will lead to the indiscriminate privatization of the power distribution sector. Delhi Chief Minister Arvind Kejriwal described the bill as dangerous and claimed that it would only benefit a few power distribution companies. Meanwhile, the central trade unions have also said that the bill aims to privatize electricity distribution. One of the main concerns is that the bill will make electricity unaffordable for both ordinary power consumers and farmers by ending all subsidies.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The government also wanted to enable regulators to fix a minimum tariff ceiling to discourage unhealthy price wars among distributors and also a maximum ceiling to protect consumers' interest. That is all for today. For more news, views and analysis, log in to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.